Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, October 25th, 2018. This is a mid-market update, second video of the day, and I'll probably do a third at the end of the day. But with a lot going on in the markets right now, a lot of volatility, I figure I probably can't do too many videos, too many updates. The more the better, since things are moving fast. I'll do things a little different than this morning's video. I'll point out some levels mentioned in the trading room, but I want to point those out here. Focus a lot when you have these intraday, these sharp bounces. We go back to the intraday charts, and I'll get to those in a second. Maybe point out some levels and some developments I haven't already. But I want to point out this level here. And I have various drawings on the QQQ daily chart, but this is one line that I've had here for a long time, 169.61. I think it's a significant level. You can see reactions going back, a gap right there, a lot of candles right there. That was a wall, a very solid resistance level, and then a breakout with an impulsive move and a back test of that level. And here we are back testing it now from above. Most recently, let's look at this. Now I talk about this a lot. When volatility is very high and you have momentum and these trend days, sharp moves up, sharp moves down, you can almost guarantee that, not completely, but almost guarantee, especially on the daily time frame, that you're going to have these support and resistance levels overshot. And what I mean by that, and this is what I call momentum fueled overshoot. We had a tremendous amount of velocity, momentum going down here, and we overshot that level intraday. That's why you have that skinny candlestick wick right there, or tail or shadow, and then we close the body right back up on support. So that support held. It broke intraday, but it held on a daily basis. We did that again, broke it intraday, but then parked right back above it here. But then finally, when we broke down, and this helps to confirm that that is a well-watched significant level, once it broke, the floodgates open, you had impulsive selling. We didn't just limp through and close right below it. So that validates that as a level. Now, support and resistance levels, just like records, are meant to be broken. You know, Michael Phelps holds the most gold medals. One day in history, someone will hold more gold medals. So, like I always say, support and resistance levels are that unless broken. So right now, this is resistance. It was former support. Once support breaks, it's resistance. So far, we popped above it intraday, but we failed there. So that's something to keep an eye on. SPY has comparable resistance here, 268.33, give or take. And remember, on a roughly $300 share price, 20, 30, 40 cents in either direction doesn't mean much, especially intraday. But you can see all the reactions that I'm drawing here, gaps, reactions from above and below, a pretty significant level. And so SPY is testing that level now. It's a hair above it at the moment, but again, I mean, we're talking statistically insignificant as far as percentages go. You really want to put it clearly in the rearview mirror. And so that's daily resistance that we're testing right now on the SPY and QQQ, which really, again, that's where you want to watch to get an idea on where the market's going. 60-minute charts, I pointed out the divergences already. I don't want to go over what I've covered in today's video too much, but they're the divergences about to be confirmed in QQQ, not yet. And we had a couple whippy signals here. So like I said, these divergences very well could continue to extend and still play out with a move, another thrust down. And normally at most points in time during this bull market, this is where during corrective phases, sharp corrections, this is where I like to position long on whether it's an individual stock or the market's 60-minute bullish divergence in a primary uptrend. However, we've just broken some key uptrend lines. We're still below them on a weekly closing basis. We're below daily trend lines. Therefore, these divergences may not play out. We could get another thrust down. And if they do play out, they could stick save us, especially if we have some big blowout earnings tonight on the big three. Tomorrow, we're rallying, 2.5% right now. We were up a little more than that before. We could certainly have another 3-4% update tomorrow and maybe park the indexes back up. We'll see. We'll take that as it comes. So let's just look at some near-term levels. I want to show you a couple things. Here's a 15-minute chart of QQQ, and I put up some Fibonacci retracement levels. If you're not familiar with what Fibonacci retracements are, I'd recommend to look it up. They're useful in trading. Some traders use Fibonacci's exclusively, Fibonacci levels to trade off of. I just like to incorporate them into my trading. It's one of many tools. And what I've done here is essentially taken the highs. The highs back in early October. That's where the market dropped. So we had that 12 or so, 11, 12% drop into the lows from that point. And I captured a few reaction highs. We had a big reaction high here after the counter trend rally. And then I looked at yesterday's big bounce into resistance. That was a beautiful gap backfill and a significant reaction. So what I did is I put up 3 Fibonacci's retracement levels, colored them differently so you can see. Got rid of some of the extra lines. Now, typically the Fibonacci retracements, I like to use a 38, 50 to 61% fib. And the yellow lines, that's right here, these 3 yellow lines, 1, 2, 3. That usually will give you an idea where a typical counter trend rally, if this is all that is, a counter trend bounce in a larger corrective pattern. If not, we can certainly go and improve to be more, especially if if that 61.8 fib's taken out and some other things. Don't take that to be a line in the sand, but once we start getting above there and that 178 level, as I said, much above that, it certainly would obscure the bearish technical outlook. But what I've done here with the fibs, where you find them useful, if you find these reaction lows and highs, which I've done here, and string the 3 different fibs up, what you have is what they call a Fibonacci cluster. You can't even see the numbers because they're so overlapped, but all 3 of those, you have a key Fibonacci level there. We can zoom in and I can tell you it's the 23.6, 61.8 on the blue one, and 38.2 on the magenta color. So this is what we call a Fibonacci cluster. And the more fib levels that you can have, again, off key reaction points, you don't want to try to force it. I don't use this. It's a reaction high, but it's not a significant one. These I thought were the most significant ones. And so there it is. You have 3 of them lining up nearly perfectly at that 170 resistance level. I pointed that out also in the trading room today. I put this chart up, and so far you can see that 170 level cap today's advance. We're rolling over from there. Nothing major so far, but again, my thoughts are you have all the 3 big FAANG stocks reporting today: Amazon, Alphabet, which is Google, and Intel. My guess is you're going to have some nervous longs that are shell shocked from this recent sell-off, might want to lighten up on their positions a little bit. It's sort of a risk-off market now, if you guys haven't noticed, meaning, when you're selling all tech and risk-on assets and small caps, those things are dropping. So I'm not sure if you're going to have more gamblers jumping in front of those stocks for earnings. And they may blow it away. Anything's possible tomorrow. But anyway, I'm just looking near term now for, and so far since I've started the video, there has been some profit taken off that 170 level. I also mentioned those points I'm just mentioning now in the trading room. So there it is. And of course, we still have, if we thrust back up, 168.83 is a pullback target. If you're trading actively, we may bounce there. And we still have this downtrend line and a lot of overhead resistance levels to contend with. So near term, I would say this is pretty much a bounce target zone I have, up to about 174 down to 170 or so. And what that would look like, and this is not just for today, tomorrow as well. I don't think we're getting to 174 today. I can almost assure you we're not getting to that today, at least not in the regular session. I'm talking tomorrow. If they blow it out today after the close, those 3 earnings reports, and the majority are bullish, or at least the market's reaction, maybe we pop up to 174 tomorrow. It would be a breakout of this downtrend line. That would certainly usher in a lot of buyers, squeeze out some shorts. And if we failed there, there's a potential for a nice, very nice bull trap. Short squeeze followed by a bull trap. It would clear out some short interest, suck in some more long. So that would be an ideal scenario if we're going to get another thrust down here in the market. Of course, resistance is resistance unless taken out. So look for any of these levels, the downtrend line especially, or that 170, we'll call it the downtrend line really. This is minor resistance there, but it could come into play. I just want to point out the levels. So that's what I'm looking at. And on SPY, I put up this chart today, 270. That was one of the levels there. I can't remember if I had that one on the chart at the first chart I posted today, but that is certainly a level. You can see, may have added that line afterwards because I have reactions here, and a couple of that back there. So I'm looking at just a minor resistance level, and so far we rejected off there. There's a comparable downtrend line for SPY. Let's look at futures. NQ, Had a trader in the trading room today. I believe he said he was in the UK, but he trades NASDAQ NQ futures, which are my preferred trading proxy. A lot of juice on those, and they trade well to the technicals. My bounce target zone would be somewhere in here from that 170.57, we'll call it 70.58 level, up to about 71.74 right there, that line there. You can see a lot of reactions along there, and you have the downtrend line resistance and price resistance that come in around 70.58. So that would be an ideal area for a reversal. Again, it entails these divergences not playing out. If these divergences, they may play out at lower levels, so basically we can just extend these downtrend lines, and this is drawing a falling wedge. And when I view this, when I look at this potential wedge pattern, that fits better. Wedges typically break out somewhere. I think this is included in the video shot. I think I'm just on the edge of the screen, somewhere around right here. That's usually where wedge is going to break out if it does. And we might have to draw the downtrend lines a little bit different, or the divergence line, I should say, something like this. And we could come down here and maybe thrust down there and still have divergence at a lower level like that. So, I mean, a lot of possibilities. All I can tell you with a fair degree of confidence of what the resistance levels are, but I have to be very clear. It is a crapshoot. If you love gambling, go to Vegas or go long or short heavily tonight into the close, because you're going to have Alphabet, Intel, and Amazon, which make up, I think I covered this yesterday, is about a quarter of the returns. Was it a quarter or more of the, oh no, 32%. Yeah, third, I think it was, of the NASDAQ 100, just those three stocks alone. Now, a couple of them could have positive earnings reactions with one negative that could cancel each other out. They all three don't have to have, positive reactions. I don't care what the earnings results are or the guidance. It's what the market's reaction is. And again, I don't care what it is after hours tomorrow. It's what happens in the regular session, how we follow through tomorrow. And really, I want to see how we end this week. But all I can tell you is expect volatility one way or the other after the close today and into trading tomorrow. And I'm giving you levels that both for longs and shorts, bulls or bears. If shorts are looking forward to short any bounce back, it could happen anywhere from here up to here, all the way up to here. This is really where you get under this level here, and I think that's probably going to coincide with my 178 resistance level on QQQ. That's where the bear scenario really starts chipping away if we get much above there. And there's a lot of upside to get there, so keep that in mind with your position sizing. I mean, when you trade with this kind of volatility, whether you're long or short, we could be looking at another 5% downside or 5% upside in just tomorrow alone. That's possible between now and tomorrow. ES for you S&P 500 futures traders, similar thing, big downtrend line to watch. We have the bullish divergence, which is certainly giving me some pause. Or right now on the shorts, you have to watch that divergence. If it plays out now, could certainly get a break out of this downtrend line and thrust us up through all these levels here. There's some more resistance there, but we can also work our way down. And the downtrend line is the first resistance with 2750 or 2751 above that, and then that 2783 level above that. So I can draw a lot of arrows, and the best thing to do, make sure your position size is commensurate with the potential for gain or loss tomorrow. In other words, we're going to see some big moves. And the old rule on Wall Street, or the old adage is sell your position down to the level which you can sleep at night. And just take it easy, keep it hedged if that's your thing, and we can always re-engage the market tomorrow. And if you have swing shorts right now, there's nothing to say that that short case has been negated, especially the fact that right now the markets have bounced back to those resistance levels I started with on the daily chart. Sorry guys, I thought I'd pause the video. I was trying to figure out which charts to go over next. What I'll do, I want to go over what I did want to do is go over the top components of QQQ, and I was just trying to figure out what time frame. So we'll keep it simple. I'll just jump the three that I'm watching right now closely, the 15-minute, 60-minute, and daily. So here's a 15-minute Apple. Apple doesn't report to next week. Apple's story is this, and get a lot of questions, and I posted quite a bit on it recently. Is this. We have this trading range here. So Apple's in a holding pattern right now. This 215-ish level is very key support. I'll show you that on the daily chart. Um, we might break out of this range or down below it depending on what the three big FAANG stocks report tonight. That could certainly be the catalyst for a breakdown. If we do break below 214 or so, 215 or 214, my first target down here is 197-ish with this uptrend line. I think that uptrend line would eventually get hit. But we could also, if everything goes well for the markets, Apple has plenty of room to extend this wedge. Let's color that yellow just to let it stand out, and color that bottom, well, the bottom trend line is yellow. So that is one potential scenario, but at best, I see another thrust up at Apple before that trend line and that 215, 216-ish level breaks, and we go down. So all that would do is simply extend these divergences and look something like this. So there's Apple. We don't have to worry about Apple till next week for the most part. But again, what the other big market leaders report today. And here's Amazon. This one reports tonight. Just looking at it, if you put everything aside, what you think the market's going to do, what you think Amazon will do at earnings, right now, this stock, it's clearly bearish, and I pointed this out, well in advance of it breaking down this uptrend line on Amazon, broke down back test, that started this correction. And right now, we hit my first target on Amazon, which is right here. It's a well-defined level. You can see all these reactions from below and above. 1766.22 give or take, and we are back testing. So if you really zoom in, what happened here, look at that perfect kiss of the 200-day EMA. See that red line? Kissed it with yesterday's candle bouncing, but we're still a little shy, or we kissed that 1766 resistance level today. So here's a stock under resistance. Earnings can change all that tomorrow, but if you put all that aside right now, this would normally be an objective short entry. Because it's reporting tonight, you might want to hold off. If you're aggressive, you take a shot there, but it's going to gap one way or the other. That's almost a certainty tomorrow. But I just wanted to share where it's at to try to gauge where things might be headed. A 15-minute chart on Amazon. There it is. 15-minute, we are at downtrend line resistance as well. So there's a stock at resistance as well as 1754. So normally I'd say that's an objective short here, but again, you'd have to maybe for a day trade. And of course, they can pop it over this, and then a day trade you could go long and target. There's one level here, a reaction high, and a gap. This would be a day trade if that's your thing on Amazon. Microsoft, we're going backwards now from a 15-minute chart, also at downtrend line resistance, or hit it today at the highs and has backed off. And was that today's high? Yeah, today's high, and it's backed off so far. So these are the levels you can replicate, and I like to take this as a whole. If you're trading QQQ or even SPY, look at these top components, see where they're going, and that'll help you give you a little more clarity to your analysis on QQQ. Microsoft had a trend line here, a little stick save. It had the meltdown yesterday, popped back above it today. So from a technical perspective, on the daily, it's not so bad right now, but we'll see where the rest of them go. Alphabet, GOG hit support yesterday at the lows, bounced a little today. But these guys, you really have to look at the weekly. Here's GOG below that weekly trend line. The Class A shares are also below the weekly trend line. Not by a lot. They can stick save it. That's the theme here. We're really getting stretched on the ability, especially for the broad markets, to stick save and get back above those key moving averages and trend lines on a weekly basis. We'll just have to see how tomorrow goes. But I just wanted to show you really zooming in on these intraday charts and show you all these stocks. There's Alphabet at downtrend line resistance as well. I think it was Amazon. Yeah, Amazon I showed you before. Here's Alphabet, GOG, and there's GOGL at downtrend line resistance. So, this is an objective level to short at the very least for a day trade if you don't want to go home long. And where's Intel? Where did I lose Intel? Go back to the Qs, my watch list. Intel. Intel is, I'm thinking about maybe going long this one even in front of earnings. Way back here, the divergent high gave two targets on the weekly chart. My minimum target of a 24% drop to 42.59, that was hit. So that was pretty decent support. I still favor ultimately a move down here to that 38.27 level. That would be a 32% drop from wherever it was when I first outlined that, I guess near the highs. So I think Intel does one of two things, and we'll know after tonight it reports. We either bounce off this level, get a tradable bounce. That would most likely align with those 60-minute divergences on the broad market playing out, and then later on come back down, maybe a few weeks to a couple months later, probably 6 weeks maybe. At most, we'll see. And then a nice reversal there. That would be a really nice long entry there if the charts confirm at a time. That's a big if. And then otherwise, we could just, if things don't go well tonight and tomorrow for the markets and for Intel, we just come on down and continue on down another 6% or so, 7, 8% from where we are now. Come down, hit that target. And if we do that, then the broad markets will probably hit a lot of my targets, and we might be able to reverse, go cover a lot of these shorts and go long as early as tomorrow or early next week. So that's it. Let's stay on our toes, and we'll see what happens from here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.